up ahead. Affirmative 612.
Scott, this week, my friend, as the year is drawing down, let's talk about automation, since that's something I'm sure pilots use quite a bit in their work as well. But automation, with savings outside of just the traditional stuff like the 401k, right? The workplace plan or whatever. I know there's some thoughts you were thinking about there. What's rolling around in your bean this week, my friend?
Yeah. So as I've had more and more conversations with, guys that are, I'll say in the back half or the fourth quarter of their career, one of the things, that comes up frequently is this discussion around how we're going to pay ourselves in retirement.
Okay.
And, like the default option that the company provides for most of our major airlines is the company contributions normally at a rate of 15 and soon to be up to 18 and maybe even 19%, of automatic contribution is always going into that pre-tax bucket, that pre-tax 401k.
Right.
For some of our higher earners, the airline is really even just hitting the IRS max from what they put in. Okay.
Okay.
That's not the case for everybody, but for some of the higher earners, the airline is just for their portion. So many of them don't even do any employee contributions. It's kind of a separate discussion on that topic because there is an argument to be made that maybe the employee contribution, which we do have some leniency there. Can we put it in the pre-tax or do we want to put it in the Roth? If we want to put that in the Roth, that's the opportunity for somebody over 50 to put in, over $30,000 a year into that tax-free bucket. Now, again, it's going to increase your taxable income. And so it might be a little more painful this year. But again, we're trying, the plans we're trying to build are balancing that tension between what is, best and least painful for today and what is 70-year-old you also going to feel like, hey, I look back and say, I'm happy I did those things. And so there's an element of like deferring the pain. And so, this savings plan, I think we can't decouple it from two other things. One is the future retirement income plan, and then also the current and long range lifetime tax plan, right? So, to me, we're trying to help people pay the least amount in taxes over time. And so there's, it's an unknown element, right? How long you're going to live? What's the tax rate going to be in retirement? There's things like that we don't fully know, but we can make some educated guesses on. But we want to take a little bit of time and say, okay, eventually my income is not going to be paying me, right? My income is all taxable W-2 income. Eventually I'm not going to have it. How am I going to pay myself? And this has led to a repeat conversation I've had many times this year. And I thought, we just need to do an episode on that. And that's really, where do we want to automate our savings outside of the 401k? Most of the guys are in some sort of automated savings plan. I mean, again, at a minimum, the company's automatically putting their automatic contribution into the pre-tax bucket. Yeah. And it's going into some target date fund. If you did nothing else ever, that's what's happened.
So we're talking about setting up some sort of automated like Roth account, or, what's your thoughts there?
Yeah, good question. So like if you think of our tax buckets, right, we have the taxable, which are dividends and our capital gains are taxed there. We have the pre-tax, which is our tax deferred, means, hey, it goes in pre-tax. It's like the 401k or an IRA if somebody had an IRA from a previous employer, or TSB for our military guys. And then we have the tax-free bucket, that Roth bucket. So there is an argument to be made. It's case by case scenario that, hey, maybe we want to do some backdoor Roth conversions. I mean, that is absolute low hanging fruit. So if we can set you up with that, that's a way that you can put, $7,000 to $8,000 in per spouse, get it over into that Roth with a couple transactions. Even if you're over the income limits, we can do that for most of the pilots out there.
Yeah.
So there's a method that we use to get that in there. It's all like kosher with the IRS and everything. And then even just getting that, 14 to 16 grand a year over in that Roth bucket and let that compound for a couple decades, it's going to be a nice chunk of change. Okay.
Yeah. Yeah. Even 10 years. Yeah. Even 55 to 65, right? It's great.
For sure.
Yeah.
Absolutely. And again, that's money that typically you're spending last in retirement. So really it turns into an account that's going to, that money you carve over there will probably sit there for 30 years. And so, we should be able to grow a really good tax-free bucket over there. And that's something that typically, that's the last thing we're going to spend in retirement. And it's typically what we're going to pass on to our kids tax-free. And so that is absolutely the lowest hanging fruit that we want to get. The other type of account, and then I'll talk about the account types, and then I'll talk about kind of the technique after that. The other type of account that we're going to get would be like an individual account if you're single, or a joint account if you're married. And that individual or joint account is what we call an after-tax account. Some people call it a cash account, even though we would recommend investing into, stocks and equities in there. And that account is the one I was saying earlier, where the dividends are going to be taxed and the capital gains are taxed. But what I want to see our guys and gals retiring with at 65 is we want to see a good chunk of change over in that account, because that's the account that we can liquidate portions of to sell off of early in retirement and basically live close to tax-free for a period of time, however long that account is going to last. Because again, it doesn't hit our tax return as ordinary income. All right. And so if I'm used to making over $500,000 a year by the end of my career, and then my income goes to zero, okay, now I've created an opportunity where at least I have a window of time, however big that bucket is how long the window of time is going to be, where I can do some other things like some Roth conversions out of my, tax deferred 401k over into the Roth bucket and do those at a very low tax rate. Like we just did a $125,000 Roth conversion for a retired person, and they had to withhold $3,000 of taxes out of it. That's a pretty good tax rate, way less than what people are doing now. And so
not bad. Yeah. Not bad at all.
Yeah. And so, and again, you start looking at the standard deduction and now the bonus senior deduction, and you're getting a lot of opportunity to do different conversions where your checking account is still getting fed. So your retirement income, you're enjoying retirement, doing what you want to do. But as far as the IRS is concerned, you're not really making any money from an income standpoint. So we can do some other things, like some Roth conversions is a big one that we're doing early in retirement at really, really low tax rates. Okay. And that's going to mitigate down the road. And for most of our pilots, they're going to be taking RMDs when they're 75 or older, but that's going to mitigate what those required minimum distributions look like, where at that point you have no control over your income, no control over what the tax rates are. And so the more that we can control, the better. But the key piece that I want to really hit now that we've kind of talked about this individual or joint account and then getting it over into the Roth IRAs is automating this portion. Okay. We know, hey, I'm automatically going to be saving in the 401k. That's happening. If I have, just the company doing it and I have mine at zero, or if I'm maxing my contributions every year, when my contributions, it's automatically coming out of the paycheck. If every pilot out there had to go in and manually month to month move money from their income over into their 401k, the savings rate would be significantly cut. And this is where we highly, highly recommend, as your income is growing up, and as it continues to expand, you don't want to fill that new raise or that new promotion to captain with lifestyle. You want some of it to get filled with lifestyle for sure. You've earned it. But we want to automate a certain portion of savings. And so we're going to take, I always recommend for guys, hey, start at $500 a month. Okay. If you just start at $500 a month or whatever, $100 a month, at least get some sort of dollar per month going into a individual or joint after-tax account, and then start to work on growing that amount. Okay. Growing that monthly amount. And then as you get a raise, you can look and say, well, I got $1,000 a month raise roughly. Let me look over. There's nothing else I really need to add to my lifestyle. So I'm going to increase my 500 to 1,000.
Yeah. Feed that animal a little bit. Yeah,
absolutely. And that monthly savings going in is going to, grow and compound over time. It's going to go up and down as the market goes up and down. But, if we can be putting in, 500, then 1,000, then 2,000, and we got many people putting $4,000 or $5,000 a month in over in that account, knowing it has a purpose. It's not just over there randomly. This is the money that we're going to use early in retirement to live off of and look poor on paper. And when we look poor on paper, we unlock a lot of other things that we can do early in retirement. But if we don't start working on it now, we really limit our options if we're waiting until we're 64 to care about this. Okay.
Yeah. And there is a lot of room with that, right? With certain ages, if you're 60 and up, right? All those new changes to the OBABA, as I like to call it, right? So you've got all the different little things, those little extra pieces. So you could really kind of get your taxable, income down a little bit too, taking advantage of some of these things. So lots of places to look.
Well, and like one of the biggest things that I've taken away after doing this for a long time now and working with many, many retired people, I've never, not one time, had a retiree in my chair in front of me or on the call say, man, I wish I would have deferred more income so I paid less in taxes back then and had a larger balance. I mean, I just have never heard it.
Yeah, darn it, I saved too much. Yeah.
Everybody wants more Roth and more after-tax dollars. And it's an element of diversification, right? I mean, we're not going to own just one stock typically. I mean, most investors would think that's a bad idea. We definitely don't recommend that. It's diversification, right? Diversification should be applied to the tax classification of our dollars too. If I have all of my eggs in one basket from a tax standpoint, all my money in pre-tax, I mean, it's better than having no money. Don't get me wrong. I mean, you got a $4 million 401k. I mean, this is like the dichotomy of wealth book we have, right? I mean, it's more money, more problems. Like you're doing okay. However, every time you touch that money, it's creating second and third order effects to your financial plan. And so having some other tax classifications of money is going to give you options in retirement. You're going to feel more empowered to make better decisions because you have options. I mean, when you're backed into a corner, now you got $4 million in your corner or $5 million in your corner. Like I said, you're still doing great, but it drives an element of tax inefficiency that you just have to deal with for all of retirement. And so if we can automate some disciplines now to start building those other after-tax and tax-free buckets outside of that pre-tax 401k, I've never had anybody show up in retirement and feel like, oh man, I regret doing that. I mean, and it's not really about the total dollars saved. It's about having that diversification, right? I mean, hey, I want to go buy a boat. I want to take a down payment out for a house. All that stuff is just increasing your taxable income, driving your Medicare premiums up, pushing you into higher marginal tax brackets. It's just one of those things that, hey, again, you got money, so it's better than not having money. But if we can make it more tax efficient in retirement, we want to do it, but we got to start now.
Yeah, and you can't get yourself thinking, well, they extended the tax, rates that we're in. Yeah, but we're still 38 trillion in debt. So odds are they're still going up at some point here in the future. So future you is probably going to be paying higher taxes anyway. So
yeah. I mean, that's a whole separate discussion and couldn't agree more, right? I mean, it's, and if I look, okay, yeah, I'm in the highest maybe tax bracket right now if I'm a senior captain, and I'm probably not going to be in that tax bracket in retirement. Understand that. And still we want to seek ways to, fund after-tax vehicles. Again, the low-hanging fruit that every guy or gal should be doing is doing the backdoor Roth IRAs for you and your spouse. I mean, again, that's 14 to 16 grand a year based off your ages, and funding $1,000 to $3,000 a month into some individual and brokerage account, and just growing those two non 401k accounts to get yourself to show up in retirement. And we can hop on a call and run the numbers and say, if you're going to save XYZ, and we assume a certain percentage of growth with a certain standard deviation of volatility, right, we're going to estimate you're going to land at, ABC dollars outside of those buckets. And then you can start to get a vision for, okay, well, if I got $1 million in after-tax money in that taxable brokerage account, I could live off of that for 5 years if I'm not having to pay taxes on it or whatever with the other income sources I have in retirement. And then I can do, hundreds of thousands of dollars of Roth conversions at the 12% tax bracket over that early retirement. And by the time you're 70, you can make a 7-figure difference in how much you've saved. It's significant, but you got to start working on those things now. You can't do that at 65 with my one pre-tax 401k. You're too late at that point.
Yeah, exactly. And you mentioned earlier, like the dichotomy of wealth. So if you guys want to pick up the toolkit, that's a great way to get started. So, check this out. Molly will come on and tell you how to get a hold of the toolkit.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own financial flight control toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
All right, man, I think that covered it pretty well today. So any final thoughts before we go?
I mean, I think the final thought is, we want to start with the end in mind. And as much as we want to automate and take off the top, the better off we're going to be. When we have to constantly remind ourselves to go do things, we're going to get busy, we're going to procrastinate, and we want to automate and build the wealth building system and then let that machine run as long as possible. So I appreciate taking some time to chat about it. And, if you need help, hit us up.
Absolutely. We'll have the links in the show descriptions below. So get yourself some time on the calendar, get the toolkit, whatever you need to do, take a little action for yourself. And don't forget to subscribe to the podcast on Apple, Spotify, and of course right here on YouTube. And we'll catch you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.